All right, so business owners, real estate investors, do you know that 60 to 90% of all small businesses require some owner financing for that business to be sold? Now, if you're the seller, this could be bad news. Now, if you're the buyer, this could be good news. Now, the first question is, so how do these professionals come up with the price, or how do you come up with the price? So it's based on the valuation, and there are three different ways or three different keys that makes that determination. The first key is the income approach, and this method determines the value of the business based on its ability to generate income, just like it sounds, right? It considers the expected future cash flows the business will produce. And the most common technique within the income approach is this thing called the DCF, or the discounted cash flow analysis. Now, here's how it works. So the estimated future cash flow the business is expected to generate, and then you apply a discounted rate to these cash flows to account for the time value of money. So, for example, for money today is worth more today than it is tomorrow, right? So, and then, so what you do is you sum up the present value of these discounted cash flow to arrive at the business value. Now, if you want to know more about that, or whatever, definitely ping me here and say I'll be happy to do a future video more on that. But so that's number one on the valuation, the income approach. Now, number two is the asset approach. And instead of focusing on the earning potential, like in the first one, the asset approach calculates the fair market value of the assets owned by the business. Now, so here's how it works. So you start with the company's balance sheet, and then you identify its tangible assets, such as property, equipment, and inventory. And then you subtract any liabilities from the total asset value to determine the net asset value. Now, some people are like, wow, that's a haircut, on that, because, you know, it might not be exactly that, because, if the building's worth X, but you have a loan against it, the person buying it hopefully is buying it for the asset value of its worth, and they're paying off the loan. But there's some discussion on it. So the method is particularly useful for businesses with significant tangible assets, but have a limited earning potential. So that's how usually that number two, the asset approach is done. Number three is the market-based approach. Now, this approach relies on the market data and compares the business to similar companies that have been sold or even publicly traded. And there's two common techniques within the market-based approach, and typically it's the CCA, which is a comparable company analysis, and then you got the CTA, which is the comparable transactional analysis. So the CCA, the comparable company analysis, compares the target business to publicly traded companies in the same industry and analyze their valuation multiples, such as price to earnings ratio, and then apply them to the target business. Now, I see this more in the mid-market, smaller businesses, mid-market companies or revenues in 100 million and above is typically on that. But the ratios sometimes trail down, and it just depends on the industry and in the business, right? And the comparable transaction analysis, CTA, how that works is they examine the recent transactions involving similar businesses, and then you look at the purchase price multiple. So, for example, you got the price to sales ratio, and you apply them to the targeted businesses. Now, a lot of times, that's usually what I see on the on the smaller business transaction, the CTAs. Now, from a funding perspective, what do you think we most are concerned about? The ability to service the debt, right? And typically, how do we find that out? A lot of times based on the net income of the business. So hopefully there's some cash, there's some net income, there's some profits to be able to service the debt. Now, sometimes there's some leeway on some add backs. Let's just say as you purchasing the business is different than how you operate than the purchase who's selling the business. And there's ways to do some, you maybe you got the whole family that's employed by the business where you buying it, it's just maybe it's just going to be you. And, there's sometimes there's add backs and everything. All right. Well, hey, I appreciate you watching, and definitely join our Keys for Business Masterclass where we talk about different strategies for funding businesses. And you can find that at the bottom of the chat, and definitely follow for more information and key things.